What is up? This is the Working Investor. I got a good one for you. In this video, we're going to talk about the market, how much the market is down, how did you do compared to this market. We're going to talk about risk on versus risk off assets. We're going to talk about leverage funds, which might do worse than others and which might favor a little bit better in a down market. And finally, most importantly, we're going to talk about recovery. Are you set up to get the best recovery on the upside when the market rebounds? As always, nothing here is financial, tax, legal advice, or bag holding advice, or any sort of advice. This is purely for fun and entertainment purposes only. See all my disclaimers. Let's get into the video. Let's start off with the ugly right away. You can see right now the VIX spiked 24%. The S&P is down 2.83%. Look at these numbers carefully. The Nasdaq is down 3.4%. The Russell's down 3.6%. Bitcoin was down around 8%. It's moving up and down all the time. I want you to look at your portfolio. Look at your performance, and I want you to ask yourself, and this is my performance, I'm down 3.09% in my main portfolio. How did I do relative to the market? What sectors, what indexes am I beating, and what indexes am I falling short? What am I doing right? What am I doing wrong? And how can I mitigate my losses? This is just an exercise for you. So I look at my portfolio. I see I have blocks. Blocks is Bitcoin, crypto. It's down 8%. So I see that, I should be down on 8%. I see that I have WPAY, which is a 1.2x leverage fund. So I should be down 1.2x times, probably like S&P 5, large cap tech like the Mag 7. They do have Berkshire in there. You can't see it here, but I also have a very small position in TSII and NVIIs. I have other leverage products in there. I also have some stack risk parity in here. Very heavy in the NASDAQ. All in all, I am down 3.09%. So this is exercise for you. So you think to yourself, okay, you're down, let's say, for example, 3.09%. Okay, I've done better than the Russell 2000. I've done better than the NASDAQ, which relative to what I hold is very heavy in tech. And I've done not as good as the S&P 500, which is down less. The question is, where did all the money go? Because think about, why is the stocks down? Why are all these assets down? They're down because people are panic selling because they're worried about some message out there. Won't get into politics, but there's some concern about some maybe U.S.-China tension between a trade war going on. Nobody wants a trade war. So people are selling stocks and, let's say, keeping it in cash, or they're putting, they're moving things around. Now look at the monetary system is a closed system. In general, it's not perfectly closed, but think of it like a closed system, and things are shifting around. So there are some winners and losers all the time. So think of stocks, bonds, commodity, real estate. There's other assets as well, of course. The question is, that's why people talk about diversification, because you want to have a bucket always available. So when the money moves from out of one bucket, at least it moves into the other bucket. So you're always ready to catch some of the water, or some of the water that leaks out of the bucket. I made a video about this one time. This is my analysis. I looked at a lot of very smart investors, and we look at it like this. There's something called the risk on market and risk off market. So risk on, people have a big risk appetite. So what tends to pump in risk on markets? It's not a perfect list here, but think of small cap. People are going to go do bets on smaller companies. They're going to go into tech. They're going to go into Bitcoin. They're going to go into meme coins, etc., because they have a risk appetite. But then when there's fear in the market, people don't have a risk appetite. Risk becomes very distasteful, and they're a risk-off environment. They want things that are less risky. So they'll move from like growth stocks to deep value stocks. Think of your Berkshire Hathaway. Not telling you to do Berkshire Hathaway, but no advice here, just showing you. Consumer staples. Instead of consumer discretionary, they're going to go to consumer staples. Some may argue that you may want to go to international. You may want to go to private equity, commodities, gold, eventually bonds and cash, depending on how far you are in the fear spectrum. That's why a lot of my positions that I have some positions in stacked risk parity, which I made a video on, which I stack up leverage, where I have, exposure to, let's say, equities and commodities like gold and the S&P 500 to give myself a little buffer for this type of momentum. If you want to break down the market by sector, this is not a full list of all the sectors, but you could see here, let's start from the top to the bottom. So you see here the U.S. real estate market, the REITs, they're down 1.85% relative to the S&P. Remember, the S&P is down 2.83%. They're beating the S&P. Technology 3.91%. Remember, the Nasdaq is down 3.4, so this is down 3.9. So you could see it's kind of, it's people are taking the money out of tech, they're putting it into real estate, they're going into, they're taking out of real estate, showing more strength. The financial sectors hit almost as much as the S&P, which is 2.73. Healthcare is hit a lot less. It's showing relative strength relative to other sectors. Consumer discretionary, look at this chart, this really big contrast. Consumer discretionary, consumer staples. You can see XLY, consumer discretionary, down 3.77%. Almost pretty much more down than like technology. And then you have consumer staples, which is showing strength here in this market because people want to buy. People still need to take care of their basic, necessities. So they go into consumer staples. That's what's pumping. And you can see the utility sector, it's down 1.18%, definitely showing a lot of relative strength relative to the S&P. And Dow Jones, 2.44% down. Since we mentioned internationals, you could go ahead and look at international markets. You can see VXUS, a famous ETF that's, international markets, diversified, a lot of baskets. They're down 2.3%. So they're also down, just like, but they're down maybe a little less than 2.83% like the S&P is. But you can see there's a little bit of relative strength there in the international markets compared to the U.S. equities for now. I guess it depends which countries you're looking at in the international markets. This takes us to point number 3. We're talking about leverage funds. So now, as you know, I have some leverage income funds. You may have some leverage income funds. The question is, which one might do worse to protect you, from the downside? Well, they're not really going to protect you, but which one's going to do fairly better than the other in dampening this market? In this video, we're just going to talk about 2 examples. RH is Roundhill. Roundhill is a 1.2x leverage. So I want you guys to focus on 2 points. I want you to focus on the magnitude of the leverage. How much leverage is it? Is it 20% or 25% extra leverage? And another thing I want you to point out, and I really want you to hone on, and people miss this, is how often does the leverage get reset? And I've made a video on this. I'll put a link in it. I'll try to find it, put a link into it. So that makes a huge difference of how often it gets reset. And secondly, or thirdly, I should say, is it just a leverage fund like Roundhill, just swaps? That's it? Or is it like RexShares, which has leverage, but it also has some covered calls, which is deriving income in a down market? It can help you provide extra income to buffer volatility, but it also has 50% uncapped. So it's thinking about whipsaw as well. So it could protect you. It won't give you the full whipsaw effect. So let's talk about the Roundhill. So you kind of saw in my little cheat sheet that they reset their leverage every week. So what does that mean? Very important to understand, right? So when it's reset every week, when you have a 1.2x leverage, so you're taking 20% extra leverage. So when the market's up, you'd expect to be up 20% more. When the market's down, you expect to be down 20% more. That's the anticipated momentum that you're anticipating when you go into the fund. However, there is something called a compounding effect that can happen because we call it path dependency and volatility decay. So what does that mean? Let's just break it down. So when the market's down 10%, you would expect to be down 12%, 20% more than the market in a week, right? But what if week 2 it's down another 10%? How do your numbers look now? So that's when you want to think about how often does the reset, how often do they recalibrate their leverage? So if it's recalibrated every week, now you're reset with a new level of leverage. So now you're down 12%. And then the next week, if the market's down another 10%, you're down another 12% on your initial 12%. So it's compounding 12% on 12%. Because it's like somebody paying interest, and the interest becomes part of their capital. Now they're paying interest on interest. That's horrible, right? So, obviously it's a lot better than your daily, daily reset leverage funds, because every single day it could compound and gets reset. But when I read the prospectus, I may be wrong, but what I understood was they, RexShares, they target about 1.25x leverage. That's what they target. They have a range, but they target 1.25x. So we'll assume it's 1.25x. So they do have 5% more leverage than Roundhill, but they reset monthly. What I understood correctly when I was looking at their holdings, that they, in their prospectus, they roll they do the leverage via not swaps, but option margin, and they roll every single month. So whatever happens intra-month, you're with the original 1.25x leverage, and your leverage gets compounded if we go into the next month. Another thing also is that your downside is a little bit blunted because it's also providing income. So your total return is being a little bit more balanced out because you're not just subject to whatever the market does. You also are deriving some income because they write cover calls in approximately 50% of the portfolio. So they're generating income. So when the market's neutral, the market's down, those calls are not going to be challenged and you'll be profitable. But obviously the risk is the whipsaw. When the market goes back up, you won't be able to get the full recovery up because you do have some capped upside. But you don't have full capped upside. You have about 50% capped upside. So 50% of the portfolio has uncapped upside. And they back tested this strategy. They were trying to find the perfect level of leverage and the perfect level of how much to write the capped upside. And I remember the fund manager was saying in one of the interviews that their target is to try to provide you the actual notional move of the underlier. So the underlier, without minus the leverage. If that was a little complicated, let me break it down. So let's say the underlier is up 5%, 10%, and you're up, you would be up, 12.5% because it has 25% more leverage, but your upside is capped. So 12.5 divided by 2, so you're going to get about 6.25% of the upside. But the thing is that they also write their calls about 2% out of the money. You divide it by 2, so you should have additional 1%, so plus 1. So now you're up. Now you'll be able to catch 7.25% of the upside. But then they also have income. So maybe you'll get, about 8% or so of the upside. So they want to get you as close as possible to mimic the upside momentum of the market. In no way, shape, and form am I pushing you to buy one fund over the other. I like both for different reasons, and I do own, NVII, TSII, and WPAY if you're following my videos. Nothing against COI or MSII. I just have a lot of Bitcoin and crypto exposure. I don't want to overexpose myself. Anyways, let me know what you guys think about, this market. What do you think is an opportunity in this market? How are you doing relative to the market? Is your portfolio showing relative strength or weakness relative to the market? What are strengths and weaknesses that you could do to be hedging? And I'm just kidding, guys. I did not forget about the last point. Let's talk about the last point. If you made it here, you guys are awesome. Let's talk about recovery, right? Are you prepared for the recovery, right? So number one, every single person here on YouTube and all the advisors are going to tell you, stay the course, stay the course, stay the course. You don't, like a roller coaster, as long as you don't jump off the ride while it gets scary and you stay buckled in and it's not going off the rails, then you should be fine. But you get hurt if you jump off the roller coaster in the middle of the ride. You don't want to do that. So whatever made one, again, not financial advice, but just think to yourself, whatever compelled you to buy this security, if you did your research, if you did well thought out research, you did not buy it on a whim, you did not buy it because of FOMO, and you really, really have a very bullish thesis for what you're buying and you have strong conviction and you have indicators showing that it actually has evidence of that it's strong, then this is all just noise, right? And you stay the course and you don't ever force yourself to sell something because of compulsion. If you're selling something, you want to make sure you're truly selling it because the thesis of why you invested in it, which was originally very strong, the fundamental reasons why are not there anymore. Possibly. Again, got to speak to your advisor. But most people will tell you right now, are going to tell you to stay the course. Secondly, my second point, very important. I have been strategizing since the beginning of the year to try to hedge and risk mitigate stuff. And I'm terrified about the recovery, right? Of missing out. I have a lot of FOMO on the recovery. This is me personally, right? And I have been trying to minimize my position in WiMAX. Nothing against WiMAX or cover calls. I do have a lot of cover call funds, but I wanted to make sure I have a lot of funds that are, do not have capped upside or minimum capped upside or less capped upside because I want to avoid whipsaw because the best times of the market usually come after the worst times in the market. I don't know if it'll be down for a week. I don't know if we're down for a day. I don't know if we're down for a year, 2 years. Who knows? Nobody knows. But I am optimistic, and maybe I'm wrong and foolish for thinking so. But I am optimistic the market is going to go back up, and I'm optimistic in my assets right now. But I want to make sure I'm going to capture that upside. So, how you think about your portfolio? Think about how much of the is everything cover calls. And in the cover call portion, how much breathing room is it at the money? Is it slightly out of the money? Is it far out of the money? Cover calls, and how much runway are you getting to capture that upside? And there is opportunity here. If let's say you were kind of thinking about rebalancing and stuff like that, of course you don't want to take losses. But if somebody, sometimes and I'm not a tax guy, so you got to speak to your tax guy. There's something called tax loss harvesting. It's a great area. So I'm sorry, I meant to say it's like a silver lining in this market. So let's say if I took a loss on paper because the market's down on a certain asset, but I go ahead and buy something very similar but still different in the eyes of the IRS, and do not buy my original asset back for 31 days at least. And again, I'm not a tax guy. You have to double check everything. Don't take this at all. This is just what I'm thinking. I can have a paper loss. I can offset some paper gains. There are some limitations of how much you can be carried over to go against your income. And finally, I want to give a shout out to one of my subscribers, to Dav F. He was asking me to do a leaps video, so I'm not going to do a dedicated one, but I'll talk about leaps in this video. So I really appreciate your comment. I also appreciate all my subscribers. I really appreciate all your comments. I really want to give all you guys a shout out. So in brief, leaps are basically trying to have a high stake bet. So basically going far out in time, and these are my leaps that I hold right now, not financial advice, I'm showing you what I have in my portfolio. I go far out in time. Some of them I don't have enough liquidity, so I can only go out 6 months, but ideally I would like to go out a year plus. Like you could see my last leap in the bottom, I have a leap on uranium and on granny, and they're granny shots. And they're out like, January 21st, 2028. I got 2+ years. And basically I pay I put up money. So that money that I'm putting up, I'm risking 100% to lose it. But instead of buying 100 shares of the underlier, I put a position up, and whatever the upside that it captures, I actually get all the upside. And my downside, let's say, for example, URA, let's say I pay $500 for the leap, for example. So if it's up, a dollar, every dollar it's up, I'm up $100. So if URA goes up, let's say $10, in the next 2 years, I'm not saying it would, I don't have a crystal ball, I would be up $1,000. And if I put up $500 on this like lottery ticket, then I could be up, I could make 200% return in 2 years. And if it's up for example, and we can get into extrinsic value, intrinsic value, but so these are things that I started putting on leaps, and I knew the market is at all-time highs, so it's obviously foolish to put on leaps when the market's at all-time highs. It's actually better to put on leaps, in my opinion, when the market's at all-time lows, because you have more upside. But I've always said I would do it when the market's down, and I never do. I always like, oh my God, I got to put up the money. So I started putting up leaps to get into the habit. It's more of a habit thing. I want to be habituated to start putting on leaps on a semi-regular basis, every month, put up a leap here and there, just to get into the habit, to break the threshold of it's a mentality thing. And I am extremely, bullish in a lot of these stuff, and we can get into more of these topics. I do talk about some of these in the video, but you can see I'm bullish on quantum computing, defensive technology, AI, stack risk parity gold and equities, granny shares, which is like a lot of themes within a theme, and then URA, which is overall uranium sector, which is going to power a lot of the AI. There's a lot of energy demand. So I have I'm bullish on these right now. I can take profits off right away if I wanted to, or I can wait until it gets up to a higher level of profit. But I am putting on some leaps to give myself a capital efficient spot. So let's say the market's down, you ever think to yourself, oh my God, the market's down. I wish I had opportunity. I wish I had some dry powder to go buy this. Well, this is I'm not telling you to do this, but I look at this like a very capital efficient way to get exposure and get the momentum of equivalent to 100 stocks per contract. but you are putting up the money. You are 100% risking, and you have to be acceptable. You have to accept that I may lose the money that I'm putting up to buy the leap. I have theta decay working against me, but I want to hold my spot in line. Like I reserve my spot. You're doing a reservation. You're reserving your spot so if you see some kind of asset that you always wanted to have and its market's beaten down, this is a strategy, not the only strategy that one could deploy. But again, this has a lot of inherent risk in it. It's not for everybody, but I'm starting to get into that. Anyways, let me know what you guys think, what you guys are doing. Give me some ideas as well. Let's all brainstorm and figure out how to take advantage of this market cycle. The market is what it is, and we just have to figure out, we have to control the controllables. We can't control the market, but we could control our emotions. We could control our sizing. We control our hedging. We could control what kind of strategies we deploy. So all we can do is control the controllables. And let me know if you guys have any cool, brilliant ideas. This is the Work Investor over and out. I hope you guys have a wonderful trading week. Be well.